But let's turn now to our next guest, Chris Konstantinos. He's the Chief Investment Strategist over at RiverFront. So, Chris, let's just kind of talk about your top view on the market right here, which is you think that valuations might keep the equity markets, at least, kind of range bound, and we've been in a fairly wide trading range for the last couple of weeks, but you're still risk on when you look at your portfolio. So what are you seeing right now in the market that's keeping you, with a risk on stance, but yet with the expectation we may not necessarily have a whole lot higher to go, and we may be stuck for some time?
Sure. Let me try to unpack that. So, first of all, we are risk on, although I would label us as cautiously optimistic, not wildly optimistic or exuberant or anything like that. So valuation's it's a funny animal, right? So if we talked about valuation in a vacuum, you would say, well, the market's at 23 times earnings, and you could roll out a whole bunch of different metrics and say, you're at the upper end of where, equity markets typically trade, not like a 1999 or a 1929 scenario, not that overvalued, but still on the upper end. And that's all very true. I don't think you can look at valuation completely in a vacuum, though. I do think you have to look at it relative to the risk-free alternative, because really what the market's doing is just taking a whole bunch of views into what cash flows are going to look like 2 years down the road, and it's discounting it back. And the rate at which you discount that matters for what the net present value of that thing is. So when you look at the fact that the Federal Reserve has said, look, we're going to keep interest rates where they are until 2022 and maybe longer, depending on the path of COVID-19, then you sort of have given the market carte blanche a little bit to say, we're going to continue to bid up, particularly companies and cash flows that can grow in an environment that's very difficult. So I would say, it's not like valuation is a slam dunk here, but neither is it a tremendous near-term headwind for the market. I think that in the summers tend to be times where you get these news vacuums. And so I think the market's going to be pretty volatile and may not make a ton of progress in the near term, but the overall backdrop for us is still somewhat conducive to risk-taking.
And Chris, you talked about valuations and about the 2-year window, at least, that you have to take at this point in time. When you think back to maybe how you would have thought about the market and say 15, 16, and obviously there's always news going on, but usually you like to have some sense of what the next year might be. Does it seem to you that investors broadly are kind of throwing out 2020 and even the first half of 2021 and looking at what companies might be there and at what price are they reasonable given how the economy may look 2 years from now, and how different is that from maybe how things would have normally been?
I think it's really different. I'm glad you brought this up, Miles. I think it's an excellent point. Anyone that has a forecast on what Q2 earnings are going to look like, or even 2020 earnings, there's a lot smarter people than me that have a ton of forecasts out there, but I'm not sure that anyone's going to be right because the visibility is incredibly low. I've been doing this professionally for 20 years. I don't know a time when visibility has been lower than it is right now. In my opinion, at least. So I think the market by necessity is having to step that forecast range out further. And I think the calculus goes something like this. So the market is roughly 3,000. The peak was something around 3,400 on the S&P. I think what the market's doing in aggregate is it's saying that 2 years from now, earnings are going to be slightly worse than where they would have been if COVID had never happened. But on the flip side, monetary and fiscal policy and what we'd call financial conditions are actually going to be easier. And you put it all together, and it doesn't get you to 3,400, but I think the market is being relatively rational at somewhere between 2,800 and 3,200. And so I think that's what the market is now doing. Is it's playing a counterfactual of, where would we be 2 years from now if COVID hadn't happened? Well, we would probably be at a much better earnings trajectory, but with a much less conducive financial conditions backdrop. Does that make sense?
Yeah, Chris, I just want to jump in here and kind of piggyback off of that, because you were saying the visibility is low. It hasn't been lower than it is right now. You don't think, at least from the time that you've been tracking this. And it's interesting. I know you're saying that you take a 2-year timeline, but when you're positioning your portfolio right now, how are you identifying those opportunities? And I guess, is now the time to still be risk off? And at what point would you switch your strategy there to be risk on?
So that's a great question. I think it depends a lot on your time horizon. So at RiverFront, we run portfolios that are optimized to time horizons, and we have portfolios as short as 3 to 5 years. And what we mean by that is in the worst case scenario that's ever happened, those clients still need their principal back or have a fighting chance of getting their principal back in 3 to 5 years. Those portfolios we run very differently philosophically than the ones where the clients have inherently said, look, you have 10 years plus before I need this back. So you can do more things on the risk spectrum. You can take longer term, more contrarian views. So what we're doing in practical terms is in the portfolios with the shorter time horizon and the lower risk tolerance, we're keeping our risk management triggers really pretty tight. But for those portfolios where, again, you have an 8, 10, 12 plus year horizon, we get to be a little bit more contrarian. We get to be a little bit more deep value. And there's actually are pretty interesting opportunities still all over the world. So, international markets have, pretty awful near-term fundamentals, but they also have a tremendous amount of long-term positive mean reversion because they've been underperformers for so long. So, in a long horizon portfolio, that could be a place where, an area that's extremely contrarian where we have some interest is Japan, for instance. Everyone hates Japan. Everyone has hated Japan for 30 years with good reason, because it's been one of the, history's worst stock markets, and an economy that's been mired in basically a deflationary spiral for 3 decades. Yeah. However, we think there's some real value there, and we think that there's some reform that's happening at the top level, driven by policymakers. That's actually pretty interesting. So Japan might be a place where we can take a bigger bet in a long horizon portfolio. But in the near term, look, Japan is beholden to what's happening in China. It's beholden to what's happening in COVID. It's beholden to the fact that the 2020 Olympics, which was supposed to be a huge growth driver for them this year, is not happening. So that kind of gives you a sort of an idea about the dichotomy we can use depending on what the investor's time horizon or risk tolerance is.
And then, Chris, finally, just before we let you go, you mentioned that news vacuum, and I think we're certainly getting a sense that we're entering one right now, and we're still about 4 weeks out from earnings season. But it seems clear that coronavirus is going to fill that, as you would expect. It's a global pandemic. How focused are you and concerned about the case count data we're seeing in a number of states? And it feels like the broad reopening has, if not reversed, it's at least on pause broadly right now. How concerned are you about that?
I think you have to be concerned about it. And you and I think we've spoken about this before, that no one really knows, right? Whether you're an epidemiologist or you're someone that does what I do, no one really has any idea what the fall might look like. We can hope for the best, but hope's obviously not a strategy. That's why I think you have to keep risk management triggers, tighter perhaps in this kind of environment than you would otherwise. But let me bring up a couple points about COVID. First of all, when you see major population states like Texas and California and Florida experiencing what they're experiencing, it's alarming. If you look at the national average, and so we track this every day, we look at a 3-day moving average of new viral incidents. What you see is basically not too dissimilar from the stock market itself over the last month or so, that it's been kind of in a range. And we are at the upper end of that range right now, which you might say could be expected given the fact that those areas I just described opened up pretty early. What this probably means is that the opening is going to have to kind of function like an accordion. This analogy I've used before, I don't know if it's a very successful one, but the idea that as viral incidence goes below that 1.0 rate, you can open things up in certain economies, in certain states, in certain regions, and then as hotspots crop up, then you have to kind of close it back down. That's why I think a pure V-shaped recovery is a little bit too optimistic. Right. But I do think we're going to continue to make progress. And if you look at like the PMIs, that in the U.S., what you've seen is a pretty substantial rebound. I think that's because the sentiment is now for business leaders. They're thinking, yes, we know that things can shut back down, but we're unlikely to see the wholesale widespread shutdown, quarantine that we saw in March. And I think that's why sentiment is a little bit better right now.
All right. Chris Konstantinos with RiverFront Investment Group. Always great to get your thoughts. We'll talk to you soon.
Yeah, thanks for having me.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.